today we're going to talk about covered calls and their merits in a investment portfolio. So I'm joined here by our Chief Investment Officer, Ken Frier.
All right, Jono, thank you. And I just want to start by saying that during our career in financial markets, each of us have executed many billions of dollars derivatives trades, including options. So we think we have enough understanding to have an opinion on this topic. When you trade derivatives, the most important thing to know is whether the price that you are trading at is a fair price. And as we're going to explain here, the amount that you receive for selling a covered call, it will always be at best a fair price and usually a bit less than the fair price or what it's actually worth. And therefore, on average, over the long term, a practice of selling covered calls will make you worse off.
Covered call writing is right out of the typical Wall Street playbook, where these strategies are really sold. They are not bought. It's very rare that a retail investor would come to a broker or an investment advisor and say, hey, I want to write some covered calls against some positions I have. Covered calls are typically offered by Wall Street either directly in a brokerage account, or they have ongoing ETFs that have covered call strategies embedded in them. Again, typical of Wall Street, they're not necessarily in the best interest of the client. They're for sure in the interest of the brokerage house or the broker that's selling them.
So a call option is the right, not the obligation to buy a stock at a particular price on a future date. In this video, we're going to use a call option on Apple for our example. If Apple is trading at $200 a share, you could buy a call on Apple that would give you the right in 1 month to buy it at $200 a share. And the value of that call would be $7. The payoff on that call option on Apple is shown in this chart. So you pay $7 up front. If the value of Apple is $200 or less a month from now, then you will have paid $7 up front and get no further benefit, because there's no point in buying Apple using the call option at $200 if it's trading in the fair market at less than that. If the Apple price is more than $200, the call has some benefit. And so the owner of the call would exercise the call and make some money. But note that the price of Apple has to go to more than $207 for the gain on exercising the call to be more than the $7 cost of the call in the beginning.
Right. So a call is a right, but not the obligation to transact. And so maybe you could explain a little bit more about what a covered call is.
So suppose you own Apple stock and your broker comes to you and says that you might be even better off if you sold the call on the Apple stock that you own. If you're short the call, you sold the call, you would have the opposite position of the one that we just described. You would receive $7 a share for selling the call. And the green line on this chart would show your payoff for selling the call. You keep the $7 premium if Apple stock a month from now is $200 or less. If Apple is more than $200, you will lose some money on the call when it expires. And then if Apple goes over $207, then you will have a net loss for having sold the call, because the amount that the option owner gains is more than you receive for the call. So in this chart, the blue line is the profit and loss on your original holding of Apple Computer. And the red line is the combination of the value of your underlying Apple holding and plus the value of the call option that you sold. Now, the reason why covered calls can be seductive to investors is if you compare your original position, the blue line, you're holding of Apple, and then you look at the position that you could get to, the red line, which is the combination of owning Apple and having sold the call, it's often the case that the red line is above the blue line, and you make more money if you sold the call than if you didn't. So you might get the idea that you'd probably end up better off by selling the call. But this seductive idea actually leads you astray, as we'll explain further.
the summary of what you're saying is that even though you're often going to be better off by selling call options, the expected loss on the outcomes where you lose money is equal to or greater loss than the expected gain in the cases where you're better off, correct?
Yes, that's right. And the way to understand this mathematically is we can divide the region of possible outcomes into three parts, which we label on this chart as area A, area B, and area C. In area A, 1 month from now, the value of Apple stock is below $200. You will have lost money on your underlying holding, but you will have sold the call for $7. You get to keep that $7. And so regardless of where we are in area A, there's a gain of $7 on having sold the call.
I do want to emphasize that it's $7 relative to a strategy of not selling the call. So your actual loss is greater than $7 because the underlying position in Apple stock has gone down. But for purposes of this conversation, we're talking about selling the covered call relative to not selling the covered call.
All right. So let's move to area B. In area B, the Apple stock is between $200 and $207 1 month from now. So you are going to give back some of your option premium to the option owner, but you'll still make a profit somewhere between $7 and $0. The third area we'll call area C. In area C, the value of Apple is more than $207 a month from now. And the owner of the call will make a profit. They'll get back from you more than the $7 that you received at the beginning when you sold the call. The tricky thing that's hard for people to understand is how much you might lose in area C. On average, it comes out to be about $11.50 a share is the kind of weighted average outcome if you end up in area C. So although area C has a less than 50% chance of happening, there's a relatively large loss on average that can be experienced in area C. So we can do a combination of these three areas, their probability of happening and how much you make to figure out what's the expected value of the call as a whole. Area A has about a 50% chance of occurring and you earn $7 there. So your expected value is $3.50. Area B has a 15% chance of occurring and your average profit there is $3.50. And so 15% times 3.5 is about 50 cents. Then area C has a 35% chance of happening, and on average, you'll lose $11.50. And so if you multiply 35% times $11.50, that's an expected loss from area C of $4. So we combine the $3.50 from area A plus the 50 cents from area B plus the negative $4 from area C, and voila, what we arrive at is what we should expect is that on average, the expected value to the seller of this call is $0.
Okay, so to summarize the slide, we do not recommend writing calls or selling calls or transacting what they call covered calls against your underlying stock positions, because even though it could very well be that the investment advisor you have has all the good intentions for you, if you look at this strategy on an expected value basis, it's $0 less any transaction fees you're going to pay. So over time, by continuing to pursue these kinds of strategies, you're just going to be bleeding money to Wall Street, and it's not good for an individual investor's portfolio. Thanks, Ken, for taking us through this topic. Please visit atlasca.com to learn more about our services to institutions and individual investors and foundations and endowments. Don't forget to like this video and subscribe to get more investing tips and advice like this as soon as they are posted. Thanks for watching.